Okay, right, let's start. So this is actually part two of the pre-scene analysis. So anybody who is watching this video or listening to this session, I believe that you should have already gone through the pre-scene as well as you have already watched the first video that we have done. If not, this is available. So the first session what we did is available in the LMS as well as in YouTube. You can watch it again. It's very important, really important for you to watch that as well, accompanying with this session. Right. So this is depending on the questions raised and the additional analysis what I have done during the week. Now, this one we already know. So about the three companies, what is given in the case study or the pre-scene is actually about the Sunshine Construction Private Limited. So this was formed in 1975 and later it has become a listed entity in 2005. Then the Sunshine Construction PLC name was changed. Predominantly it construct buildings, highways, roads and plus apartments and bridges. So the construction projects are undertaken by this company. I'm not going to talk about the directors, chairman, which we have already looked at. And I mentioned that it has become a listed company in 2005. And, like information about the chairman, then the independent directors, MD and vice chairman. Kosala has become the vice chairman later. Initially, he was the MD, son of Punchipanda. Those information we have already discussed, right? So the shareholding structure, that is initial shareholding structure, and after it has become in the after it has becoming a listed entity. So the shareholding structure was also mentioned over here, right? So if you look at the current shareholding, Punchibanda is holding 40%, his son Kosal is holding 16%, Gamunu and Kamal, two executive directors, are holding 2% each, and the public holding is 40%. Then the second company is Sunshine Manufacturing Private Limited, SML, which was formed in 2003. So that company actually a manufacturing company of construction related material. So mainly concrete blocks, autoclaved aerated concrete blocks are manufactured by this company. Russian plant in Putlam. They manufacture make to stock and make to order. And yet again, information about the chairman, MD and the executive directors are given. So this particular company, Sunshine Manufacturing, SML, 80% is owned by SCL, that is the parent company, Sunshine Construction, and 20% is held by outside investor. He is the MD of the company, Somapala. And if you look at the real estate and residency, Sunshine Real Estate and Residency, this is actually the real estate company. Real estate, apartment, and the housing schemes are undertaken by this company. So this company was formed after the rights issue, after the IPO, not the rights issue, after the IPO done in 2005. So it has actually a condominium with 225 luxury units in Kolpiti, as well as there's a land. So that is to build and sell individual units suiting for the customer specific requirements, right? So the if you look at the financials of this company, actually financials are not that great because of the issues that we have in the construction industry, real estate industry. Negative net assets are there at the moment when it comes to the balance sheet of the company. So the company is 100% owned by SCL, Sunshine Construction. In addition to that, you have been given information about the drop in revenue. Group revenue dropped by 13%. Then the SCP, that is the parent company, Sunshine Construction PLC, revenue dropped by 24%. Then the GP margin of the group, 22% to 14%, there's a drop. GP margin of SCP, parent company, that is the company level, it has come down from 19% to 17%, right? So overall, what we can say is profitability is affected, right? Revenue has come down, top line has come down, bottom line also has come down. There's a margin pressure. Then you have been given information about the manufacturing company, SML. For the financial year 22-23, company made a loss of 38 million. Demand dropped by 60% compared to the pre-pandemic situation. Financial year 2018 and 19, comparing with that 60% drop in the volume. And the receivable value has gone up by 50% compared to the receivable balance was at 18-19. So the government as well as the corporate sector, they are not paying on time. So obviously we discussed there are impairment allowances to be recognized with regard to these balances. Then if you look at the issues, a lot of projects are kept on hold. There are pending projects, right? So those are under inventories, right? Because the progress was poor. Now, when it comes to properties, you should understand, depending on the purpose of construction of these properties, either it can be the inventory or else it can be the investment properties. If you look at the balance sheet of this company, you have inventory as well as investment property work in progress as well. So if you are constructing a property to future use as an investment property, which means your intention is to rent this and earn a rental income in the future, it's an investment property under construction, right? On the other hand, if you construct something for the purpose of selling, you construct and sell. For example, there's a housing scheme. As per the information given, if you look at this, land in court to build and sell individual units. So your purpose is to sell, build and sell the individual units. It would have been inventory, because why? Your purpose is to sell in the ordinary course of business after the construction, right? Depending on the purpose, it can be an investment property or it can be the inventory. Now, whatever the situation, the properties or the construction work is kept on hold, right? Then trade receivable of the group and SCP, that is the parent company, have go beyond the credit policy of maximum 45 days. Their credit policy is 45 days, but credit period has gone up more than 45 days. That's why I said that additional impairment allowances to be recognized. Should have been recognized, because why? The collection is not that great. Because of the tight economic conditions, customers are making the payments on time. Then plant and machinery, what you have purchased in the past, are not utilized in full capacity because low demand and the tight financial position of the company. There's no demand for the product, so the machineries are not used in the full capacity. So these are the what impairment indicators. So there should be an impairment testing to be done and see that whether impairment losses has to be recognized. Then the bank is putting pressure on the outstanding OD facility. Might have been these are overdue now, not paid on the day that it has to be paid. Because of that, bank is urging to restructure the debt. So overall, what it says is companies having issues in terms of the working capital management. And also there are unsettled liabilities in terms of the OD facilities and the other financial liabilities that the company has. Then there are certain projects which are on hold, right? That would affect the company's operation. And there are demand drop, receivable has gone up, revenue has come down, margins are affected. So the overall situation is not that good. So this is about the entire scenario, what it was discussed in the pre-scene. I just wanted to summarize it again. Now, in addition to the points what we discussed earlier, what else that we need to look at? Now, before moving to my analysis, let me show you the annual report and explain about this classification of properties into either inventory or the investment properties. So let me go there one second. I'll answer to the questions at the end of the session, right? So I'll go through and thereafter I will answer, because some of the questions what you raised is covered within the presentation itself. That's why. Now, if you look at this particular company's balance sheet, right? Sunshine Construction PLC. Group and the company. Company means only the Sunshine Construction PLC is here. Group means you have all three companies in addition to the parent company, manufacturing company, as well as the real estate company. If you look at, there are significant balances, investment properties that you understand. So these are the properties either you keep for the rental purpose or capital appreciation purpose. There's no issue on that. Then there are certain investment properties which are work in progress. Then I told you there can be work in progress items under inventories as well, but it is not specifically given. But within this figure of inventories, definitely there can be, properties which are under the work in progress stage. Now, if I go and show you in a real scenario with regard to, this is actually the annual report what I have used in the previous session as well, mostly annual report of Access Engineering PLC. If you go to the balance sheet or the statement of financial position of the company, right? If I go there, right? So you see, it is the same presentation. What they have done was investment properties have been shown separately. Then investment properties work in progress. Then with regard to the investment properties work in progress, I explained in the previous session as well. Now let's say with regard to investment properties, you have a choice now in terms of the subsequent measurement. Either you can measure that at cost or else you can measure it at fair value. Let's assume you measure the investment properties at fair value, right? So most of the companies are measuring that at fair value, which means you record the value gains and the losses in the profit and loss statement, and there are no depreciation. But there can be a situation where certain investment properties which are in progress, you can't reliably determine the fair value. So in that case, what do you do? Up until you can measure the fair value reliably, or else up until you complete, whichever happens first, you measure these investment properties at cost. That is allowed in the standard. So as soon as you can measure the fair value, or as soon as you complete it, whichever happens first, at that time you start valuing the property at fair value. Then under inventories, if you look at 18.1, these are I want to mention. So under inventories, you have the figure over here. If I go to that particular note, 18.1, like go there. Down. Right. So you see, under inventories, in the note, it's mentioned work in progress. These are I mentioned. There can be properties which you build and you want to sell. Those are under inventories. That can also be under work in progress. Then with regard to inventories, what is the measurement that you use? You measure the inventory cost or NRV, whichever is lower, right? You measure the inventory cost or NRV, whichever is lower. Now, at the moment, you are measuring those at cost, right? So you can have another question on measuring the inventory, because why it was mentioned in the pre-scene, certain projects are kept on hold for long period of time, and sometimes certain materials have been purchased at a very high price where we had these import restrictions, and even in the local market there's a shortage. So you would have incurred a higher cost. Whether now the cost what you incurred is higher than the net realizable value. So in that case, there will be a what? Inventory write-off. But what you look at is, I will have that particular question in the PowerPoint presentation. What you look at is, if the particular project is in work in progress, what you need to look at is, okay, after you complete, whether this project is a profitable project or not. Sometimes there can be a situation, you have a cost in the statement of financial position, but the replacement cost of the materials are low now because you have paid higher prices. In the past, you have paid higher prices. Now the cost is high. If you replace these materials at the current prices, prices might be low at the moment. But that's not an indication for you to say that you have to do an inventory write-off. Your NRV is less than the cost. What you look at is, okay, once you complete this particular project, if the particular project is profitable, once you complete it, you don't write off, right? You don't need to write off. I'll address that particular point also in my presentation, right? So this is what I mentioned, remaining work in progress are stated at cost in this particular company. Work in progress, what is included under the inventory in access engineering. So they have measured that at cost. And over here it's mentioned inventories are measured at lower of cost or NRV after making due allowances for the obsolete and the slow moving items. Then the cost is the weighted average cost. Then what it includes within the cost is also included. So the cost of the inventory is comprised of cost of purchase, that is the material cost, then the cost of conversion, whatever the labor cost, other production overheads that you incur to bring the inventory into the current condition and location. Excluding the borrowing cost, but the borrowing cost for the inventory that are qualified assets are capitalized as part of the cost. Okay, this is another point what I have included in my presentation. If you have any borrowing cost, because if you look at this particular group, they are geared. That means they have significant amount of loans taken. Now, definitely the amount of the loans that they have taken, part of that would be utilized to construct or to finance these projects. If these projects are financed by using those debt, whatever the borrowing cost that you incur on these projects to be capitalized, because these projects are qualifying assets. Because qualifying asset definition in LKS 23 is what? Asset which necessarily takes substantial period of time to get ready for the intended use. Definitely these projects are taking substantial period of time to get ready for the intended use. So that borrowing cost what you incur to be capitalized. But yet again, during the period where the projects are kept on hold, what are you doing with the borrowing cost? Can be capitalized during that period? Probably not, right? So if you keep the projects on hold during that period, if you incur borrowing cost, you should not be able to capitalize. So that I'm going to again address in my presentation. So basically, I'm bringing out the issues by referring to these numbers given in the pre-scene, as well as by referring to the annual reports. I'm bringing the issues. So I'll give the answer to these issues once I go through the presentation. That's why I wanted to have a detailed analysis after doing the first session. Another session to explain about these matters a bit in detail. Right, so let's go to the presentation now. I have explained about the three companies. So the analysis is looking at the accounting standards and the consolidation. Okay, this is the first point what I mentioned. I explained that in this scenario, the projects, either it can be inventory, either it can be investment property, so the projects would take necessarily substantial period of time to get ready for the intended use. So as per the standard, depending on the circumstances, any of these can be a qualifying asset. I have given you examples for inventories and the investment properties in this situation, right? So the point what I want to mention is, if those borrowing costs are incurred in relation to these qualifying assets, those borrowing costs should be capitalized. There's no doubt on that. But by giving or by looking at the information given in the pre-scene, there are situations where these projects are kept on hold. During that period where the projects are kept on hold, can we capitalize the borrowing cost? I'm not going to discuss all these things, what's there in this timeline of capitalization. You should know when to start and when to stop capitalizing the borrowing cost in terms of a qualifying asset. I'm going to explain about those. If you can't remember, go and watch the relevant video of LKS 23. So I'm going to just discuss about this capitalizing of borrowing cost, whether you can continue to capitalize or whether you should suspend during the period where the construction work is kept on hold. What do you say? Normally, if the construction is suspended, or if the activities are suspended, activities are not happening, you can't capitalize the borrowing cost. During that particular period, if you incur any borrowing cost, you should charge that to the profit and loss statement. But by saying that, if one of these three conditions, what is mentioned over here, is satisfied, you can continue to capitalize the borrowing cost even though the activities are suspended. Out of that, what is important, there are three criteria. Yet again, I'm not going to discuss about all three. Out of that, what is important is this one: temporary delay caused by an external event. Okay, can I say that? Can I say that I hold this? I hold these projects. I hold these projects due to an external event, which is a temporary delay. Can I say that? So in that case, if I can prove that, I can continue to capitalize the borrowing cost. No, right? Because it's not a temporary delay. Temporary delay means something, if I give an example, so there's flooding in the construction area where you can't carry out the construction for 2 weeks. So that's a temporary delay caused by an external event. But here, you hold the construction for months, you can't say that it's a temporary delay. So which means during that period, you should suspend capitalizing the borrowing cost in terms of the qualifying asset. That particular qualifying asset can either be the inventory or it can be the investment property what we have looked at earlier. Right. I hope you understood about it. Then moving on. Then applicability of this standard, LKS 37, provisions, contingent liabilities and contingent assets, where now once these projects are kept on hold, right, you have your own problems. That is understood. But do you think that the customers who are actually now customers are waiting up until you complete their work? They have their own plans. So customers can sometimes take legal action against you as the projects are not completed. Either pay our money back, or else they will ask the penalties, fines from you. There can be court cases. So in that case, there can be a situation of creating what? Provisions. If it's probable, it's a provision. If not, it can be a contingent liability which you disclose. So there can be a question on that. Right? In addition to that, the concept of onerous contract would also come into play in this particular standard. What is that? Let's say there's a project that you have undertaken. You know that now the prices or the revenue or the contract price was negotiated before these tough economic conditions. So you agreed a price. Now you are doing the construction. Now what has happened was suddenly the economic conditions have been changed. Import restrictions, material shortages. Because of that, there's a huge escalation of costs. Every aspect of the cost has gone up. Now we know that there's a contract which I need to complete. I am bound to complete this, but my unavoidable cost of the contract is higher than the economic benefits. If that is the situation, what I have to do? I have to make a provision, because these are onerous contract. Unavoidable costs are higher than the economic benefits. So what is the provision? There's a present obligation under this particular onerous contract which I need to recognize as a provision. What is the value at which I need to make this provision? You have to look at two things. One is, what is the net cost of continuing the contract? If I continue with the contract, how much of revenue that I can generate, how much of cost that I have to incur? What is my net cost? After deducting the revenue, how much of net cost that I have to incur? And you also compare that with, if I terminate the contract today, because I know that there's a loss at the end. If I terminate the contract, how much of penalties, fines that I need to pay? You compare these two. Out of these two, what you take? The lower figure. If you're a rational person, you go ahead with the lower option. Regardless the management intention, here you look at these two, and out of these two, you select the lower option. And that amount you have to recognize as a provision in terms of this onerous contract. Okay. But let's say if you can cancel the contract today without paying any penalty, then it's not an onerous contract, right? Let's say that you know that there's a contract, my unavoidable costs are higher than the economic benefits, but there's a provision in the contract agreement to say that at any time, if I want, I can cancel the contract without paying a penalty. Then it's not an onerous contract. To be an onerous contract, you can't cancel it without paying any penalty. Okay, in that case, you compare these two and you take the lower value as the provision of this onerous contract. I hope you understood that. Okay. Then with regard to inventories, I have mentioned the matter. So inventories are to be measured at lower of cost or NRV. And look at this question and say that what would be the answer? This is what I mentioned earlier. So let's assume construction materials costing 24 million board for a profitable construction project. So your inventory has 25 million. So you put in this particular project, but this is a profitable project. Since buying these items, cost price has fallen. Now, even though you bought it at 24 million, now the price of these materials have come down to 20 million. My question is, at the moment, this is the value at which you show the numbers in the financial statement, might be material or might be work in progress. My question to you is, should there be an inventory written off, inventory write-off? Do I need to reduce the value to 20 million? Because if I buy the same materials or if I do the construction now, it would cost only 20 million. Do I have to recognize a write-off of 4 million? The gap between 24 and 20? No. Right, this is what I mentioned. Rule is what? Rule is lower of cost or NRV, not the lower of cost or replacement cost. 20 million is your replacement cost. Inventory standard doesn't want you to measure the items at replacement cost. Now, the important point here is the particular project. The project is still profitable. We know that once we complete, we can make a profit. Since the project is known to be profitable, your NRV should be above the cost. So because of that, inventory can be continued to measure at cost of 24 million at the moment. Are we clear with that? Do you understand? Hope you understood, right? Okay. Moving on. SLFRS 9, financial instruments. Okay, this is one other area I just want to touch upon, that is on your balance sheet. You have a huge amount of receivable balance. As well as in the pre-scene, in several places, we are talking about receivable is high, it has gone up above the credit period that it was originally offered. It is above the group credit policy and all that. So with that, examiner can think of, okay, managing receivable is a hassle for the company. Why don't we outsource this job to a factoring company? In that case, what can be tested is factoring of receivable. So the factoring means what? You transfer these receivable balances to an outside organization called factor, and you ask that particular company, outside company, to manage the activities and collect these dues, right? So where you get an advance payment. So by transferring these receivables, you don't get the full amount. Maybe you transfer the receivable and you get 80% out of that. Then you ask factor to manage and collect. So then the question that is raised is, what are we going to do with the receivable balance? Can we derecognize these receivable? If you consider this as a sale of receivable, you can derecognize. Or else, should you consider the advance proceed that you received as a secured loan? You can't derecognize the receivable, you keep it, but the proceed that you received, you recognize as a loan that you received from the factoring company. The accounting treatment is depending on who bears the risk. Okay, what risk? Default, that is irrevocable debt, and the slow payment of debt. Who is going to bear this risk? So there are two types of factoring arrangements. Again, I'm going very fast because these concepts have been discussed, right? So there are two types of factoring arrangements. One is with recourse, that is what is popular, right? With recourse in the sense you transfer the receivable balances to a factor outside company. If there are irrevocable debt, okay, if there are certain debts which has gone bad or you can't recover, factor will transfer that responsibility back to you. So which means when I'm transferring my receivable to the factoring company, risk and rewards are still retained with me. Whatever the slow payment, whatever the irrevocable debt, so I have to bear those ultimately. In that case, you can't consider this as a sale of receivable. What you need to consider this as just you are taking a loan by keeping the receivable as a security. So whatever the money that you received as an advance, you need to debit cash and credit a financial liability, a loan. So the double entry would be for the proceed received, debit cash and credit financial liability. So the receivables are kept in your books. You can't consider that as a sale. That is with recourse. Without recourse means other way around. So I transfer to the factor. If customers are not paying, that's not my problem. So that risk is with factoring company. Whatever the risk with regard to irrevocable debt, slow payment of debt is transferred to the factoring company. That is actually a sale of receivable. So at the time of transferring the receivable, I can de-recognize my receivable and recognize the amount what I received in cash. But as I said, most of the factoring arrangements in practice are with recourse, right? With recourse. Right. So just thought that, okay, that particular question can be tested because in many areas of the pre-scene, so it has been mentioned about these receivable balances and no. Okay. So this one I have already explained to you. In terms of the onerous contract, I have explained. Then with regard to claims, because the projects are kept on hold for very long period of time, customers might be not bearing with the issues with the company has. You have your own problems, but customer would come with a legal case saying that you promised to complete this on this date, you have not done it. So these are the additional costs that he has to suffer. So because of that, made that payment. So then you look at whether the three conditions, if it's a provision, three conditions of provision is satisfied. There should be a present obligation as a result of a past event that can either be a legal or constructive obligation. If it's a court case, that's actually a legal obligation. Then the outflow of economic benefits are probable. Probable means what? More likely than what? More than 50% chances they are to happen. That if you can estimate the rupee value reliably, you need to make a provision, right? Sometimes it might not be probable, it might be possible, right? If it is possible, what do we do? It's a contingent liability, right? So basically there are other rules which are applicable when deciding a provision or a contingent liability. But I just wanted to tell you in summary, if this is a summary, if it's a liability, if it's an asset, if something is virtually certain, in case of the liability you provide, asset you recognize. Virtually certain means what? It's an industry practice, 95% or more normally, right? Probable means more likely than not. Probable is defined in the standard. What do you mean by more likely than not? More than 50% chance. More than 50%. Right? If it's a liability, probable provide, but asset, if it is probable, you just disclose. Prudence concept, right? You don't recognize the assets even though they are probable. You recognize the assets only if they are virtually certain. On the other hand, liabilities, if it is possible, that is 50 or less. 50 or less, you disclose, but assets, if they are possible, no disclosure even. Again, prudence would come into play. If it is remote, remote means 5% or less. Liabilities as well as assets, no disclosures. So these numbers I have mentioned, out of these, as I mentioned, only the word probable is defined in the standard as more likely than not. That is more than 50% chance. The rest of the other three are actually practices used in accounting. Right. What else? What else? Leases. With regard to the leases, I have explained you, if you look at the balance sheet, you have right of use assets and the lease liability. Okay, so because SLFR 16 is a popular area of the examiner, so he can test the test SLFR 16 question in terms of the lessee side. In addition to that, why I wanted to discuss this today is actually he can test the lessor side as well. In a lease, what you do, you convey the right of use the asset. Lessor convey the right of use the underlying asset to the lessee for a period of time, and during that period, lessee make the lease payments to the lessor. Now, lessee's side we discussed in the first session, that is, lessee has recognized all leases except for short-term leases and the low-value items in the statement of financial position of the lessee. There's no classification as such into finance or operating lease in the lessee's book. It's a lease. So the all leases except for the two exemptions, you have recognized the lease liability and the right of use asset. We know that. What I'm looking at is lessor side. Now, as they are into property business, okay, so they are into properties, construction, real estate, there can be a situation they have a property, they leased out this property. Let's say there's a property where normally the useful life of the property, I'm taking only one indicator to assess whether it's a finance lease or an operating lease, because if you are the lessor, still this classification of finance and the operating leases are applicable. At the inception of the lease, lessor needs to decide whether it's finance or operating, depending on the what has happened to the risk and rewards with regard to the underlying asset. If the risk and rewards with regard to the underlying asset is transferred to the lessee, that's a finance lease. If the risk and rewards in terms of the underlying assets are retained, it's an operating lease. So there are, 5 primary factors to be looked at, as well as 3 additional factors to be looked at. Based on that only, lessor classifies a lease into finance or operating lease. I'm not going to discuss all these things. I'm just taking one, indicator, an example. Let's say there's a property. So normally the useful life of the property is, let's say, 50 years. You leased out this property to someone for 5 years. What is that lease from the lessor's perspective? Is it a finance lease or an operating lease? Is an operating lease, right? Because the useful life is 50 years, you leased out to someone for 5 years. So, how the lessor should recognize this particular property? The property would become an investment property, because why? You are earning a rental income out of this property. So, the property has to be accounted as an investment property in the balance sheet of the lessor. Then the rental income that you receive to be recognized in the P&L over the period, but remember, on straight line basis. Okay, straight line basis. Because maybe on annual basis there would be increments. But what the standard says is, take the entire lease rentals that you receive during the period. When you are recognizing the P&L income, it has to be on straight line basis. That was mentioned in this annual report as well. If I number 5, I believe, on the revenue, it was mentioned. Yeah. So if you look at this, so again, Access Engineering PLC, this is the accounting policy in terms of the revenue. If you look at this one, rental income, look at this. Rental income arising from operating lease on investment properties, what I have mentioned, is accounted on a straight line basis over the lease term. Your rental income is taken to revenue on a straight line basis and including the revenue in the statement of P&L as it is in operating nature. This is the point what I want to mention. Right. If it's a finance lease, what will happen? If lessor transfer the risk and rewards incidental to the ownership of the underlying asset, then you need to de-recognize the particular property and you need to recognize the lease receivable. That's a financial asset. You have to apply the accounting treatment of finance leases in case of a lessor if it's a finance lease, right? So let's say the useful life of the property is 50 years, you are renting out to someone for the entire 50 years. That means what? It's a finance lease. Risk and rewards have been transferred. You need to derecognize the property from your books. You can't keep the property in your books. Instead of that, you have recognized a financial asset called lease receivable. Okay. So this is about classification of leases into finance and operating leases. I have explained that to you. Right. So I'm touching upon the important aspects that can be, examinable. Then revenue from contracts with customers. Again, this particular standard, and we have discussed this in detail in the first session. So I told you the revenue recognition standard is important. So because of that, I have uploaded even the entire video series, what I have done with regard to the revenue recognition, even in your LMS, in the revision batch as well. So if you can't remember the things, please go through the videos once again and, revise your knowledge. So we discussed this in detail. So I explained that there are 5 steps of revenue recognition. I'm not going to go through each and every step. So, but in this particular question, the important aspect is this: recognize the revenue when each performance obligation is satisfied. There I told you the revenue or the satisfaction of performance obligation can happen either over the period of time or else at a point in time or over time. At the inception of the contract, you have to decide whether the performance obligations that you have in this contract are going to be satisfied over time or point in time. That also I mentioned. Then I explained to you the guidelines given in the standard to identify whether the performance obligations are satisfied over time or point in time. So first of all, you look at whether it is going to be satisfied over time. It is satisfied over time if one of the following criteria is met. Satisfaction of one out of these 3 are enough. Where I explain about these 3, right? So the first one is, I told you it's relevant with services mainly, right? Where customer is receiving or consuming the benefit while seller is performing. Simultaneously, seller is performing and consumer is benefiting or receiving the service. Good example is, at this moment, I'm lecturing. So you are getting the benefit immediately or simultaneously, right? So it is relevant with the service contract mostly. The second point is, seller, that means company, create or enhances an asset where customer has the control while it is created or enhanced. Let's say if you are constructing something or property on a land belongs to the customer. If you stop the work today, who has the control over the work in progress? Customer has the control over the work in progress, right? So in that case also, you have recognized the revenue over the period of time. And what is mostly important for this particular matter is, I think, the third one. That is, seller's performance doesn't create an asset with alternative use, which means it's a specialized asset, customized asset to a particular customer. If customer says no, seller doesn't have any other alternative, right? Without incurring a significant economic loss. Seller doesn't have any other alternative. And 2 things. Actually, in the third point, there are 2 things to be satisfied. And it is connected by using the conjunction and. And means what? Both has to be satisfied. And seller has enforceable right to payment for the work performance that he has completed. If he has completed 40% of the work, he should be able to collect 40% of the consideration. There's an enforceable right to receive the payment for the work he has done. Now, with regard to these, apartments, you can have, it is depending on the contractual terms. Now, let's assume a scenario where you are constructing something for the special requirement of the customer. It can be, now they have this land in Kotte, so they construct housing units based on the customer specific requirement. Customer say that, okay, I need this floor plan. These are the ways it has to be constructed. This is the material that you need to use. So that is specialized in nature, right? And also, if you have an enforceable right to collect the payment for the work that you have done, let's say if 40% is the work complete means if you stop the project, if customer says that, okay, he can't continue with the project, you should be able to recover 40% of the consideration. If these conditions are satisfied, what will happen? Revenue is recognized over the period of time. Not only that, if I take another example, it's an apartment. Let's say when it comes to apartments, customers say that I need this particular block. I need the sea view of this apartment, not anything else. And also, as it is allocated to me, do it like this. Okay, again, what do? You do certain amount of customization. You sell a particular block that is in preference to the customer's requirement, and the agreement is such that you need to sell that specific apartment to this particular customer with these specifications. Yet again, what is that? It doesn't create an asset with alternative use, specialized asset. And if you have an enforceable right to collect the payment for the work what you have done, then you recognize the revenue over the period of time. But there can be situations of this as well. That's why I said that it depends on the contractual arrangement. Arrangement can be, it's, standard apartments, right? All are same. There's no, difference, right? So in that case, sometimes it might not be a specialized one. Okay, if this customer say no, you can sell it to someone else. So if that is the case, you can't recognize the revenue over the period of time. You have recognized the revenue at a particular point in time, once the control is passed. Okay, so the answer to the question is depending on what is given in the question. What is the nature of the work? And more specifically, to recognize the revenue over the period of time, this has to be satisfied. You should have an enforceable right to collect the payment for the work that you have done. Right. So that's why I just wanted to give the additional clarity. Then about SLFRS 13, now, the application of SLFRS 13, right? That is, this particular standard, SLFRS 13 provides guidance on how fair value should be determined, right? How fair value should be determined when an initial or subsequent fair value measurement is required by another standard. So the point what I want to mention is SLFRS 13 doesn't tell you when to fair value, what items to be fair value. No, when a separate standard says that an item to be initially or subsequently to be measured at fair value, SLFRS 13 provides guidance on how to fair value. So it discusses about the fair value hierarchy, fair value techniques, different markets, principal market, most advantageous market, right? So now the application of this standard for this question, if it is tested, can be with regard to investment properties mainly, right? Because if you look at the balance sheet, you have a significant amount of investment properties, and certain investment properties are in progress as well, right? So if this is tested, what you do is you follow what is mentioned in the standard. So the popular exam question would be out of the value hierarchy. While you have level 1 inputs, company has used level 2 or level 3 inputs. Or while you have level 2 inputs, company has used level 3 inputs. So they are going to highlight that, okay, company has not followed these guidelines. Just thought of, including this for the completeness of the session. So it's not difficult, right? If it is tested, I think in this particular scenario, it's with regard to an investment property valuation. Okay, as it has a significant balance in the statement of financial position. Right. So those are the additional areas what I wanted to highlight in terms of accounting standards. In terms of consolidation, actually, I covered yet again. So all the consolidation possible scenarios I have covered in the first video. If you have not watched, please watch it. It's available in the LMS as well as in YouTube. So ensure that you must watch it, right? So these are only an additional points what I wanted to mention because so we discussed about this. I'm going to go through again. So the structure is what? SCL is the parent company. Parent company is having 80% holding in SML, manufacturing company. and parent company is having 100% ownership of the real estate company. So the parent is having two subsidiaries, 80% in SML and 100% in SRERL, SRERL. Okay, so this is the structure. Then I was telling you all what I was discussed, different scenarios. I told you about the acquisitions and disposals, where one of the scenario what I mentioned was disposal of SRERL, this one, right? I explained this because it has negative net assets and the economic conditions are not good for the construction of apartments and all. So the projects are kept on hold. You might think of disposing this particular subsidiary, right? There I said that you need to be familiar with the disposal accounting, how to calculate the disposal profit of a once you dispose a subsidiary, how to show that in the statement of profit and loss, right? So calculation of the disposal profit and all that to be looked at. So this is the scenario I explained, right? You have two subsidiaries. The question can be you just remain or you just keep SML and dispose the SRERL. Student asked, okay, can it happen in other way? Which means you retain SRERL and dispose SML, possible, right? But it's not a new scenario. Why do I say so? Because it's the same disposal accounting. Only thing is here you are disposing a subsidiary with 80% profit. So your disposal profit calculation includes a certain amount of NCI value as well. That's the only difference. But it is yet the what disposal accounting. So if you know how to account for the disposal of SRERL, the same approach to be followed in terms of the disposal of SML. There's nothing new, right? That's why I just wanted to point that. So the situation can be this. You retain SRERL or SRERL, but you disposed SML. Okay, disposal accounting. If this is the situation, I believe that this comes with an equation as well, which means you dispose SML, right? Then in addition to that, as discussed in the last session, you acquire one subsidiary or a group. It can be a one subsidiary or it can be a subsidiary already having another subsidiary. Then from the point of view of the SCP, you have a subsidiary as well as you have a sub-subsidiary. You have to apply the accounting for the vertical group. On one side, disposal accounting, you dispose SML and you acquire a subsidiary or a group. Okay, so these are possible situations where it can be tested in terms of consolidation. Okay, additional things. Because again, I remind you, watch the first video, right? This doesn't include everything. I have discussed, explained other possible scenarios in terms of the consolidation in my first video. Right, so that is it with regard to this particular matter. Okay, that is it with regard to this particular matter.